Now, this right here, this is what I'm called falling in love with this thing because, so it's not really surprising that with these two grades right over here, we're getting this, right? It's actually a really good, solid company, not gonna lie. This is looking really, really promising, all right? Actually, wow, look at that, whoa! Oh, wow, I didn't even realize that. What? This is a company that hit rock bottom. Hello, my fellow investors, and welcome back to another viewer-requested fundamental analysis video. Let's spin the wheel, guys. We got, 5 more companies to do, and after this, we're going to move into the June recommendations, and after that, when July starts, we're going to have to put it at a pause because, I kind of want to cover the earnings, especially when it comes to the banks and the big tech companies when that comes. But for now, let's spin this wheel to see what company we get. And we got the company DOX. Now, this company was brought up by none other than, if I can find it, Anand Tandon. So here is the comment where he recommended this. And yeah, guys, let's take a look at what this company has to offer, the fundamentals, what they do, and see if the current share price, this is looking like a buy. All right, everybody. So here we got the company Amdocs. Now, I have no idea what this company actually does. Looks very, very cool, though. Like, oh my God. You can see here, interesting. Explore 5G, automation, cloud, digital financial services, media. This is all over the place, but nonetheless, this is looking really, really cool. Now, let's actually figure out what this company does in their company profile. We got Amdocs Limited through its subsidiaries provides software and services worldwide. It designs, develops, operates, implements, supports, and markets open and modular cloud portfolio. The company provides CES 21, a 5G and cloud-native services-based marketing leading customer experience suite that enables services providers to build, deliver, and monetize advanced services. The Commerce and Care Suite for order capture, handling, and customer engagement. The Monetization Suite for charging, billing, policy, and revenue management. Intelligent Networking Suite with, oh wow, okay, so they just keep naming all of these things that we just saw over here, I am assuming, right? The financials, the cloud, the digital, etc, etc, etc. So they essentially, guys, they make a software which does all of this crazy stuff. They got a ton of employees too. Look at this, 30,288 employees. This is not a tiny company at all. I was looking at this, I'm like, this isn't looking like a, it's looking like a whatever company. No, it's actually really, really big. Now, let's come into their earnings because they did have it on May 11th. EPS normalized actual came in at $1.47, which was in line. EPS gap actual $1.23. No telling me if it's in line. I'm guessing I'm guessing that one's also in line since I just think that they maybe not showed it. EPS gap actual $1.23. The revenue actual $1.22 billion, which was a beat by $6 million. So let's come now into the calculator. This is going to be an interesting one. We got the ticker for DOX, market cap of $11.25 billion, a P of 21.1 with a current share price of $93.53. So just this share price alone, guys, as well as the PE, is telling me that it is overpriced, but it's not looking too bad. Now, taking a look at this company's graph, we can see that on the 1 year, they are up 8.25%. Year to date, they're up almost 2%. 52-week range is $76.79 to $97.08. Now, they do pay out a dividend, guys, of $1.74, which, by the way, this is a yield of almost 2%, a payout ratio of 29.56, a 5-year CAGR of 12.23, with 6 consecutive years of dividend payment. Ex-dividend date is actually coming up on the 29th of June. Payout date will be on the 28th of July, and they pay their dividends quarterly. And of course, based off of the current shares outstanding and this $1.74 dividend, we see that, well, guys, the amount of dividends paid every single year, it is $209.15 million. And after this is paid out in regards to the 5-year average free cash flow, they're still left with almost $300 million. And as of their last year's free cash flow, it is $320 million. And these payout ratios end up being, well, 39.54% for the last year's free cash flow and 41.16% for the 5-year average. So they can still afford to continue to increase this dividend in the long run as well. Alrighty, so let's start with the fundamentals. And of course, looking at the net income, I gotta say, But by the way, just full disclosure, these fundamentals actually do not look too bad. So let's see what the final grade ends up being. We got the net income, guys, 5 years ago of $354.4 million to 1 year ago of $550 million, increase of 55%. You can see that from 5 to 4 to 3, very nice consistent increase, a pretty big spike from 3 to 2, but then it came back down to reality. But you can see that if you just ignore this 2 year ago value, it's actually kind of falling in line, not gonna lie. So for this reason, I'm actually going to give this at around, I would say, like an 85%. Looking now into the free cash flow. Now this one's a little bit trickier because you have a lot more up and down movements. 5 years ago of $325.6 million to 1 year ago of $529 million. That is an increase of 62% with an average of $508.1 million. So you can see here that that was a pretty big spike from 5 to 4. Then it came back down to, you know, what you would expect it to go down by, right? 325 5 years ago to 452. Yeah, I kind of see that. Then we see another massive spike from 3 to 2 years ago. 2 years ago definitely does seem to be like an outlier so far. And then it comes back down to 529, still higher than that of 4 years ago. So I'm going to give this guys a little bit lower of a grade. I'm going to say at around like a 75%. Looking now into the revenue. This one looks absolutely amazing. Here's the reason why, guys. 5 years ago of $3.97 billion to 1 year ago of $4.577 billion, increase of 15.14%. And the reason why I love this so much is because very nice consistently increasing of their revenue, no massive outliers. You can see that the graph almost touches the trend lines every single time. So guys, this is a 100% easy. Looking now into the assets minus the liabilities, kind of difficult, but you can see that it's slightly increasing, though kind of remaining flat all throughout the past 5 years, but nothing too major to look at. Average total assets, it is $6.2 billion. Average liabilities, it is $2.6 billion. Doing this difference, we get $3.61 billion. I'm going to give this guys a bare minimum. It's not increasing, but it's also not falling too much. Like, it has had its down years, but it's kind of recovering sometimes. Like, you can see that 3 years ago at $3.665 billion. And today is right now is $3.629 billion. So it's getting there. So that's why I'm going to give it a 70%. Looking now into the cash flow minus the liabilities. This one unfortunately doesn't look too good. You can see that the lowest point was actually 1 year ago. So really, really close to today. Even though, guys, if we take a look at the free cash flow one more time, even though the 1 year ago value was the highest aside from the 2 year ago value in the past 5 years. So that's a little bit concerning to say the least. Nonetheless, though, we can see that they've had 2 years of increasing cash flow minus the liabilities, 5 to 4, and then from 3 to 2, but nothing really too major, except for the 5 to 4. That one's pretty big. And even then, guys, the 1 year ago value, it is a lot lower than that of the average of negative $1.89 billion. I'm gonna give this thing, I would say, around like, oh man, I would say around like a 40% or so. It's not a good metric at all. It has its instances of going up, but it's just not consistent enough for me to fall in love with it. Looking now into the shares outstanding. Now, this right here, this is what I'm called falling in love with this thing, because I would, so far the fundamentals have been really decent, all except for that cash flow minus the liabilities. This one right here does it for me. Really nice consistent decrease in the shares outstanding in the past 5 years. In fact, it's nearly perfect. 5 years ago of 140.2 million shares to today of 120.2 million shares. That is a decrease in the 5 year of 14.27%. And from the previous year to the current year, it is a buyback of 0.5%. Again, guys, every single year, consistent buyback, very consistent buyback. So, you know what? This is another 100% in their pocket. Really, really nice. And lastly, cash and equivalents that currently hold $623.4 million with an average of $630 million. So, it's not really surprising that with these two grades right over here, we're getting this, right? It's actually a really good, solid company. Not gonna lie. It's a really, really good company. We got, guys, the net income of 85%, free cash flow 75%, revenue beautiful 100%, assets minus liabilities kind of flat but still 70%, cash flow minus liabilities the worst one 40%, shares outstanding of 100%, nice consistent decrease, overall grade of 82. So this is, from a fundamental perspective, I'm loving this. I really, really am. Now here comes the part where we're gonna have to cross our fingers. Is this a good price to buy it today? Fundamentals are looking amazing, but I don't know where this thing is at right now, right? The PE tells us from earnings that it's a little bit expensive, but that doesn't really tell us much of anything. So let's see what price we should pay for this company today. And looking at the discounted free cash flow, guys, this is looking really, really promising, all right? Not inputting anything, just the required rate of return, which I put in for myself. You guys could put in whatever number you want. Guys, now adjusting for debt, $46.39. Adjusting for debt, $97.98. Again, current share price is $93.53. So just that alone, whatever number I put here in the positive, which I'm fairly certain we're gonna get positive numbers here, this is just going to go higher. So let's take a look at the revenue growth assumption for Seeking Alpha. You can see here that it's expected at 6.69%, so almost 7% in the forward revenue. So let's come back over here and let's input some numbers. Let's go a little bit lower than 6 though. Let's go with 4% for the lowest assumption. Let's go with 6% for the median, and let's go with 8% for the highest assumption. Now, the projected share buyback, really, really nice, consistent, 15% the past 5 years. I don't think that they'll do that necessarily. So let's say at around like 6% for the lowest. Let's go up by 2, so let's go 8%, and then let's go to 10% for the highest assumption. This puts me with a target share price, not adjusting for debt, of $56.78 to $67.86. Adjusting for debt, this jumps to $119.07 to $141.46. Really, really good, honestly. 5, 10, and 15% margin of safety, $101.21 to $134.39. So if you all remember this 52-week range of 76.79, which was the lowest in the past year, well, coming back over here, guys, we can see that that was actually very, very close to that of even the highest assumption. So yeah, you did have the ability to buy this thing at around, you know, $62, $67. It really is interesting. And of course, adjusting for debt, this thing just rises up massively. Now, in the past 52 weeks, we can see that the highest point is $97. I don't know if they've ever been any higher than that on the max. Actually, wow, look at that. Whoa! Oh, wow, I didn't even realize that. Guys, I know we're in the discounted free cash flow part, but wait a minute. What? This is a company that hit rock bottom during the .com bubble at $8. Whoa, guys. This is a really good company. What? This is a prime example of how you can I should have looked at, whatever, we're covering it now. This is a prime example, guys, of how you can overpay for growth. Look at this price tag back in what, March, May, April of 2000. What, $81? And after 23 years is when we're finally reaching that price again after that massive cut. This is exactly what I mean by overpaying for growth. Guess what? Now that we have kind of just subsided with this whole entire business over here of the .com bubble, well, my discounted free cash flow is telling me that it's a pretty good buy right now. So interesting. Wow, what a company. I'm actually really, really liking this right now, because not only does it prove me correct when it comes into the whole aspect of, hey, don't overpay for growth. Here it is, guys. 84. Look at this. July 10th, $84.94. Collapsed all the way down to $8, $6.41. That's insane. That's absolutely crazy. And only now, 23 years later, roughly 23 years later, it is coming back to the same price that it was before. And now my discounted free cash flow is saying, hey, it might be a pretty decent buy right now. That's incredible. Absolutely incredible. So proof that you can 100% overpay for growth. So right then and there, this is actually a really good company right now to buy. Well, it's an interesting company to buy. Obviously, this is not financial advice. Every investment is the present value of all future cash flow. Please, guys, have these calculators. They are available for free. I want you guys to be making your own financial decisions. Please do not follow me, because what I invest in may be different than what other people invest in, right? I have my own personal reasons. Other people may have their own personal reasons. So please do your own due diligence. My calculators are here to guide you in a direction as to whether or not you would like a company. And honestly, this company, I gotta say, it's actually really good. Not gonna lie. I don't know when I may want to buy it. I kind of don't want to add to any more positions, but man, if I was looking to add a tech company, this would be absolutely it. Like, seriously, this could be absolutely it. This has a lot of potential. there's a lot of potential, not gonna lie. So obviously you guys need to make that decision for yourselves. Nonetheless though, again, all of these calculators are linked in the description below. And I highly suggest you guys also look at their earnings as well as their 10Ks. All we're asking for in return, guys, for daily content, daily uploads, live streams, all here on the channel, free calculators. It is just like, subscribe, comment. Really does help here overall, guys. Thank you so much for all the support. We really, really do appreciate it. And, you know, okay, the company has a lot of good growth prospects, right? Not a bad dividend either. Well, I guess it could be better, but let's face it. Yeah, it's an alright dividend, right? I've seen a lot worse. Putting in $5,725, you would get, guys, an annual dividends of $106.51. I would prefer if it was a little bit higher, but again, the fundamentals, like a weighted grade of 82. It's really, really good overall, guys. However, not everything is sunshine and rainbows. The options chains here aren't that exciting. Like, they got June, July, October, November, and January of 2024. That's it. And looking at the June 16th, which, you know, is, as if I'm recording this, it is what, 9 days from now? Guys, you can see that there's only one put, and that is for $90 strike. And in regards to the call, it's $35 for a strike of 95. Looking at the July one, though, let's see how this one fares. Not any better either. Yeah, this company just doesn't have a lot of liquidity. It really, really doesn't. But again, the fact of the matter is that their fundamentals are really, really solid overall. So all in all, thank you so much for this recommendation. Honestly, man, I might actually look further into this one. Because this is, yeah, I'm actually taken aback by this. I really, really am. I'm not saying it has a potential to be the next Microsoft, the next, you know, whatever. But those fundamentals look really, really good. So anyways, guys, that pretty much does it for this video. You guys can follow us on the new tech sites. Link is in the description below. So that said, peace out, and we'll see you all next time.